Good morning. Andrew Radkiewicz, PGIM Alternatives Global Head of Debt Strategy. Today we're going to talk about real estate debt, what's gone on in the last few years, what we're looking at going forward, and then different, perhaps, structural and cyclical opportunities around the world. Quick intro to what we do in private credit, insurance-owned asset manager. So on the investment grade senior debt, we've got quite a large balance sheet, both in real estate debt and in corporate debt, which allows us to pull together a large global platform, many offices around the world, that then supports our actual third-party private debt platform. In real estate debt, I hate to say this, but I've been here over 15 years, and in that time we've done about over 17 billion of business across over 300 investments. Probably interestingly, most interestingly here, about half of that is actually outside the US, predominantly Europe. However, moving forward, market factors, interest rates. I mean, it's become increasingly clear that long-term interest rates and property yields are highly correlated. And that's sort of seen in most of the graphs, one showing here. And that's what we see continuing into the future. So what does that mean? These are central bank policy rate paths, as we've seen back from 2019, zero interest rates pretty much around the world, and then the spike from 2021 going forwards. And now we've started to see the drops coming down. Pulling together economists, researchers, etc., we're looking towards those rates sort of coming down towards that 2 to 3% mark. And that's the sort of theory that we're looking at going forward, looking at the property markets. How that translates to the actual values in real estate, as we see here, US, Australia, and Europe, we've had a pretty seismic drop in real estate values. Europe's actually a little bit worse than after the global financial crisis. So peak to trough values, about 28% drop. But what that doesn't show is different asset classes. And we've had some asset classes, such as offices, show valuation drops towards 50%. So it's been very, very dramatic. The light red here really shows impact on loans and loan to values. So if you look at any loan here written sort of from just before 2018, given that they're underwriting much higher property values, there should be some stress in there. However, it doesn't really tell the whole story if we look at the forecasts. There is forecast already a decent pickup in values going forward. So probably better here when looking at loan to values, stressed loans, it's better to look at the peak to trough towards